Hi, everybody. I'd like to welcome you to Citrin Cooperman's first live Future Reimagined webinar. My name's Alan Beatty. I'm the president and New York City managing partner at Citrin Cooperman. And I'd like to thank all of you for tuning in today to hear and listen in and get some insights on what's going on in the real estate world. There are some housekeeping things just to take that out of the way to begin with, is that there's a Q&A button down at the bottom. If you have any questions, there's a chance that we'll get to one or two questions at the end of this. I invite you to ask your questions. So with so much negativity going on in the world, and with the pandemic and everything else, we really wanted to bring you some good news and some good things that are going on in the business world. Our series, The Future Reimagined, is just that. Insights from business leaders that we can all learn from. We couldn't be more honored than to have Jordan Slone with us this morning. He's the CEO of Harbor Group International. And what I'm going to do now is I'm going to turn it over to my partner and our real estate practice leader, Mark Mindick, who will lead the interview. Mark?
Thank you, Alan. Jordan, welcome. And we're so excited to have you with us today. Your reputation and success in the business is unparalleled. And just like all of our guests, I'm looking forward to learning a lot today. So Jordan, if you don't mind, I want to give a very brief overview on Harbor Group before we get started. Harbor Group is a globally integrated platform that owns and manages 250 assets worldwide, including 45,000 multifamily units and 4.8 million square feet of commercial real estate and various preferred equity and mezzanine and other loan positions. The aggregate gross asset value is in excess of $12.5 billion. Harbor's global team of over 1,150 employees facilitate acquisitions, dispositions, asset management, construction, leasing, and property management. As a diversified investment and management company, Harbor Group strives to exceed the standards set by the industry and investment community. One more fun fact about Harbor Group before we get going is that it has earned the continued success of more than 500 investors who have been investing with them for over 20 years. That's amazing. Being a close friend of Harbor Group and its principals, management, and team for the past 15 years, I'm personally an eyewitness to all of this, and we are flattered to be privileged to have you, Jordan, with us today to enlighten us, our clients, our referral sources, and friends. So let's get started. So Jordan, coming off of one of the largest, if not the largest, national multifamily portfolio deals, just under $2 billion, known to Harbor Group as the Sunbelt portfolio, this downturn probably shocked you and your company in a very different way than many others. Being used to operating an extremely large and diverse business with tremendous activity and deal volume must have been a huge challenge. Can you talk to us about how you pivoted the company? Can you take us through the process you went through and how you kept your team focused and motivated?
Yeah, well, first of all, Mark, I want to thank you and I want to thank Alan for having me today and all those who are out there watching. So it's a real pleasure and honor to be with you today. Mark, the pandemic, there's many things that in my life and in my career that I can say I have a lot of experience in, but pandemics that's not one of them. What was really interesting, though, is that I do travel a lot. And right as the pandemic was starting to hit, I was actually overseas at the time. And the term coronavirus or COVID was a much bigger topic overseas in the Middle East than it was in the United States at the time. I mean, in the United States, when I got on the airplane, coronavirus was something that was in China and really wasn't impacting the United States. When I landed 10 hours later, everybody was talking about it. So I immediately called back to my team and I said, this is something that the United States is going to have to deal with. This thing is spreading. And first, I can't say enough about the team at Harbor Group. They really are fantastic. So, one of the things that we did is we immediately, in 2 weeks, we examined every area of our company, both corporately and at our properties. And we put a freeze on hiring. We also look to reduce expenses wherever we can. In fact, there was some of our staff that we decided that we could do without. And when it came to our properties, we stopped all capital improvement spending. And we really looked at cash positions. We did sensitivity studies for our properties to see if we stressed them, if people didn't pay their rent, where would that leave us in cash position wise. So it was really something, again, not having a lot of experience in pandemics, but having been, after 35 years, having been through several cycles, I knew that it was something that we had to address rather quickly.
Great. So let's contrast the current recession with the Great Recession of 2008. I specifically want to start with a deal that always sticks out in my mind as a great investment thesis. Your 2009.
Mark, I'm sorry. By the way, Mark, there's something else. I'm sorry to interrupt you, but sure. I do want to go back. I want to go back to the other thing that we did, which was so important, and I'd be remiss if I didn't say this. And that is, we also had to address the safety of our tenants, our residents, and our employees. And that was really, first and foremost in our minds before we did anything else. So we took steps to again, to protect our employees, and we came out with new policies, as I'm sure your firm did as well.
Yeah, absolutely. And that's absolutely the #1 priority. So thank you for pointing that out. So let's go and contrast the current recession with the Great Recession of 2008. And let's specifically start with a deal that always sticks out in my mind as a great investment thesis, your 2009 investment in 4 New York Plaza. Can you talk to us about the transaction and contrast that opportunity with what you're currently seeing out in the market today?
Sure. Well, first of all, we were looking at the New York market for a long time. And for a long time, we felt it was too expensive. But we kept our fingers on the pulse of the market. And frankly, for many, many years, we were wrong because we thought it was too expensive, but yet the market kept going up. And in 2009 came around. By the way, we actually ended up closing the deal in January of 2010, but we negotiated the deal in the fall of 2009. At that time, JP Morgan, again, they also were moving quickly to adapt to change, and they decided to sell several prime buildings that they had in New York City. We focused on 4 New York Plaza. That was a big building, 1.1 million square feet in lower Manhattan, and not as many people focused on that property. There was another building that they focused on across from the Empire State Building, and then what was called at the time One Chase Plaza. But we focused on 4 New York Plaza. JP Morgan also was willing to lease back the building for 15, they're willing to lease back 75% of the building for 15 years. So we really decided this was a perfect deal for us to enter the New York City market. We felt the downside risk was limited with plenty of upside potential. And we were buying the building, of course, as I said, with JP Morgan as the anchor tenant on a long-term lease. And Mark, I'll just tell you a really funny story. We closed on the deal in January of 2010. We bought it for $107 million. Soon after, I was asked to participate on a panel in New York that the New York Post, Lois Weiss, is a reporter with the New York Post, was hosting. I sat on the panel with a lot of big name real estate people. And frankly, once we kind of got off the stage, a lot of them came over to me and they said, Slone, what are you thinking? Don't you know that nobody makes money on real estate in lower Manhattan? And of course, we got the last laugh. 26 months later, we sold 4 New York Plaza. Again, I said we bought it for 107 million. We sold it for 270 million 26 months later. So it was really
Wow.
a deal that I will never forget. But you know, one of the things in terms of contrasting it to where we are now, first of all, we haven't seen yet the deep distress deals in the real estate world today, except when we are seeing that in retail and we're seeing it in hotels. Multifamily and prime office buildings have not declined much. We have not seen cap rates go up a lot in those sectors. We think we will see further decline, particularly in certain things. I think multifamily will be more resilient. What we have seen is we've seen lenders who are pulling back. And by the way, in 2009 and 2010, that's something that really caused the deep drop in real estate prices, was the freezing up of debt. There were no lenders. We bought 4 New York Plaza. We actually had to go to a French bank to finance it. But there is still liquidity in the market today, and that's one of the things that's helping prop it up. I do think we will see, particularly in certain asset classes, I do think we will see cap rates go up, therefore a drop in prices. But so far, it hasn't happened yet.
Great. Thank you, Jordan. As a leader and a trendsetter in this business, and for the namesake of this interview, I'd like to get into the future reimagined. How do you see the future, specifically regarding the opportunities as we come out of this downturn? Where do the markets go from here, specifically regarding the focus of Harbor Group and what your plans are for future investments and the future of your organization?
Well, that's a big question, and I'm going to break it up into a little bit into smaller pieces. But you know, first of all, we're seeing technology like in a lot of industries, and frankly, the real estate industry has not been an early adopter of technology, and they're playing catch up. But we're seeing a lot of technology now come in and change things. Just the other day, I went into an office building, and as you know, probably your building in New York, you generally walk up to the counter. The security guy at the desk asks you to sign in. Maybe he takes your picture. I went into an office building, walked in. There was it said, "Look here." There was nobody that had to sign me in. It took my picture. It took my temperature. And it knew who I was from being there a previous time and gave me permission to go in. So that's just one example of how technology is changing things. And we're seeing that happen in other areas, in apartments where you have the smart locks that know when you come and go. Our tenants take virtual tours. They can go online and take 3D virtual tours of apartments. We do online leasing. So these are some of the things that we're going to see more and more as we go into the future. Now, as it relates to the investment side, I mean, one of the things that we're looking at right now, and we've been doing, as you mentioned in your opening remarks, which, by the way, thank you very much for being so complimentary. But we're doing more lending now because we think that, as I said, we think that we will see some distress in the market. Even though there is liquidity and there are lenders that are providing debt today, there's not as many, particularly in the mezz and pref space. So, we've kind of rotated towards that, and we like those opportunities today.
Great. Is that something that you want to invest in as far as like prop tech goes? Is that interesting to your company as well, given that that's part of the future here?
Yeah, so it's definitely interesting to us. We have made a few prop tech investments so that we could keep our fingers on the pulse of things. We want to keep up with what's happening in technology, and we felt that by investing in a prop tech fund, it would give us a view toward what was coming down the pike, and maybe in some cases even give us a maybe an opportunity to be one of the first to actually come out with a product or test the product. So it's definitely an interesting space.
Great. The key to success in this business is adapting to change in the economy, in culture, and in trends. Not too many companies do that as well as Harbor Group. It would be very valuable for our listeners to hear from you what your secret sauce is in achieving that. Can you enlighten us a little bit?
Yeah, well, I don't know that I would call it a secret sauce, but I will say this, that we've been in business for 35 years. We started off just buying apartments, and then we got into office buildings. But today we have a very, very broad platform. We buy real estate, we lend on real estate, we do first mortgages, we do mezz loans, we do preferred equity. As you know, Mark, we also are very big buyers of mortgage bonds, particularly Freddie Mac mortgage bonds. So we also have a hedge fund. We have a hedge fund that deals in publicly traded securities, and everything is related to the commercial real estate business. So we got a pretty wide view of the entire real estate spectrum. And, at least we think it gives us the opportunity to adjust to trends, and we look for the best risk-adjusted returns. Now, how that plays out is, again, today, we have, we're still looking at buying real estate deals, and we are buying real estate deals, but frankly, our debt platform's even more active, and that's really because there is a lack of options for borrowers to go to. That's created more opportunities for us.
Great. One of the many areas that you have mastered, from my perspective, is the diversification of capital. As discussed, that is what allowed you the opportunity to swiftly capitalize on opportunities such as for New York Plaza, even in the darkest of times. I personally highly respect the focus you have as a company. No matter how large and successful you have become, you never lose that focus. Can you share with us how you developed that concept and what keeps you focused on that end of things? While on the other hand, you've been so focused building out a massive portfolio.
Yeah. Well, Mark, I will say, you in the previous question, you asked me about our secret sauce or our special sauce. The diversity of our equity base, that really would be our special sauce, our secret sauce, whatever you want to call it. When we started, like a lot of people, we started out with individual high net worth investors. And then as we grew, we started attracting the attention of institutional investors, both domestic as well as foreign institutional investors. And we had an opportunity. I remember, I guess this was in the late 90s, maybe into the early 2000s. Mark, you may remember GE Capital. They were a big real estate player, one of the biggest real estate players. And we used to borrow from GE. And one day they came to us and they said, you know what? We're willing to provide for you all the equity that you need. You don't need your high net worth investors anymore. And I went to my partners and I said, you know what? They make it sound so good, but our investors have been with us for, at that time, maybe it was 15 or 20 years. I said, we're not gonna just leave them. They've stuck with us through thick and thin. And even today, as you mentioned, we're nearly a $13 billion company. We have investors of all sizes, Forbes 400 family offices, money management firms, insurance companies, large foundations. We still, though, kept to our individual high net worth investors. Along with them, we've let them participate through a fund that we do. And so it's really through, thick and thin, we have an equity bucket that we can tap into. And quite frankly, and I'm proud to say that during good times and bad times, really all of our investors, the institutional ones as well as the individual ones, have stuck with us.
Great. To build on that question for a minute, can you talk to our listeners a little bit how your funds work? They're pretty unique from my perspective, and I'd love for you to share that with our viewers, how that works and functions.
Absolutely. So, you know, I mentioned a minute ago that as we started attracting institutional capital, it began to squeeze out our individual investors. So we decided about, I guess it's been now about 15 years, that we decided to create a fund for high net worth investors to participate along with our institutional investors. So we do a fund that the investment period is 1 year, and that fund takes a small piece of every deal that we do. On average, it's probably somewhere between 15 and 20%. So if it's a deal we're investing, well, you mentioned early, we did at the beginning of this year, we did a $2 billion transaction. We put about $580 million into that transaction, which was one of the largest apartment portfolios that's ever been done. But our fund got to participate along with our institutional investors, which included a foreign, very large insurance company, a pension fund, a couple of Forbes 400 family offices. But our individual investors, many of them, as you said, that have been with us for many, many years, got to participate in that deal.
That's very exciting. It's amazing the access you give to even those smaller investors to participate in such investment grade deals. And kudos to you for that. Before I turn this back to Alan for the Q&A session and wrap up, I want to thank you, Jordan. This is all very, very inspiring. Thank you so much for giving us this time today. Well, I want to wish you and Harbor Group much success in the future. Now I'd like to turn it back over to Alan for a Q&A session and some final wrap up. Thank you.
Mark, thanks. Appreciate doing this with me.
Great, pleasure.
I thought both of you did a fantastic job. I got to tell you that the insights, Jordan, were really inspiring and very insightful. So let me ask a couple of questions. We have a couple of comments and questions. Could you comment on the office building market? Are there any near-term valuation or rent collection deterioration yet? And what is Harbor Group's long-term view of the office building and leasing of office space? Has there been a fundamental change due to COVID and the rapid expansion of work from home?
Alan, I'll tell you, that question is the #1 question that I get asked today. So you nailed it with that question. So it's got a couple pieces to it. First of all, in terms of rent collections, for buildings, and we have two of our office buildings, two of our major office buildings, one in New York and one that we have in London, have co-working tenants. Not WeWork, but they have other co-working tenants. Those types of tenants, which generally, by the way, do very well, they really do. Their customers have not been able to come because of the lockdowns. So they've suffered. But really, with the exception of those types of tenants, along with any retail tenants that might have been on the ground floor of our office buildings, we have not had any deterioration in rent collections in our office buildings. As it relates to, though, also the question that we're all, or at least most of us, are working from home these days. No, working from home is not a new thing. It's been around, what do they call it? Telecommuting. It's been around for years. There was a time back probably 10 years ago, a lot of the Silicon Valley firms were encouraging it. They kind of got away from it because what they missed was the collaboration that people had when they were together. I know when I'm in Norfolk, I walk back and forth to my partner's offices constantly, all day long, and they're in and out of my office. So that's something that working from home, you just can't do. So I think in the short term, there will be an impact. I think there's already been, you've probably read, it's been in the news. Some firms are looking at, scaling back. But in the long run, maybe we'll have, less office buildings, developed, maybe less inventory. That's okay with me. As a person who buys existing stock and owns existing stock. But at the end of the day, I do not think that this is going to change the office building business, like, let's say, what Amazon has done to the retail business.
Yeah, we're seeing the same thing. I think our people would love to get back to work and
Right.
back in the office setting.
As do ours.
Yeah.
Do ours.
New York City obviously is a particular challenge, and what do you see from a New York City standpoint?
So, there are some markets that kind of go like this and like this and like this. I mean, New York has always been a roller coaster. Right now, frankly, is not a good time for New York real estate. The real estate market. It's very, very difficult. I mean, obviously, it's not new news in terms of all of the severe rent control that was put in on the multifamily side. But you have a lot of challenges today. There's a lot of tremendous amount of condo inventory coming into the market. In the office building, you have a lot of new construction. I mean, had that downtown. They have the West Side Yards. There's Midtown. There's new construction. So there's definitely some strong winds facing New York City, and political forces that are not necessarily favorable for the real estate world. But all that being said, Alan, I believe over the long run, New York always seems to come back strong.
Don't bet against New York City.
Don't bet against New York City.
Yeah. All right, two more questions and then we're going to wrap it up. The next question was with regard to the non-core sector of the real estate market. Is it better to access that through the publicly listed side of the real estate market, specifically like digital storage, healthcare, life sciences? Does Harbor Group have exposure through that, or are you more secular rather than cyclical?
Well, again, that's a trick question, Alan, because I mentioned earlier about.
I didn't write it, Jordan, just so you know. I'm just.
Well, so I said that our platform is pretty diverse, and we actually have a hedge fund that invests in publicly traded securities. So through our hedge fund, we have exposure to those areas. We invest in healthcare, we invest in data centers. So we do have exposure there. On the private side, we personally do not go out and buy data centers or buy life science office buildings. But I think it's an interesting area. I do. So.
Listen, I think that this has been fantastic. I'm so happy that you were our first guest to come in and speak on this, because I thought your insights.
I was the guinea pig. I was really the guinea pig.
Exactly. All right, one last question. Can you share with our viewers one lesson that you've learned from the crisis that you can take away with them?
Yeah. Wow. Well, let me say this. Let me say a lesson that I have learned from this crisis as well as previous crisis, whatever the plural of crises is. It's to take action swiftly. Don't get stuck in the mud. Don't wait around to see what it looks like after the bomb has been dropped. I mean, we move very, very quickly. As soon as we see that there's something extraordinary about to happen, we take actions. We take actions. We can always put back what we took away, or we can always pivot back to what we were doing. But that's really the lesson that I would say that I've learned over 35 years and being through many cycles, and a couple of severe ones. First of all, the late 1980s, 2008, 2009, and what we're going through today is move quickly to take action. And by the way, it's not always doing something defensive. It could be to do something offensive as well. Times like this create great opportunities.
I think that is very sage advice. So thank you. I'd like
Thank
to
you,
thank
guys.
Yeah, you did a great job. Thank you, Jordan, for being here. I'd like to thank all the participants that jumped on. We had almost 300 people on the line, so thank you very much. Our next presentation is going to be July 27th, and everybody should look out for the invite. Thank you, everybody.
Alan, Mark, you guys
Thank
take
you.
care. Enjoy being with you today.
Take care, Jordan. Be well, Alan.
Take care, everybody.